Afternoon, everyone. Thank you very much for joining us, both online and in person, for today's presentation. We're very excited to feature Xtraction Services, Inc., an equipment financing company for hemp and cannabis manufacturers in North America. The company actively trades on the CSE under the ticker symbol XS. From the management team, we're joined by David Kivitz, the CEO, who will be providing a corporate overview, as well as answering any questions you may have after the presentation. Please be mindful of the cameras situated throughout the room, as this is a live webcast to a large online audience. And again, we ask that you keep all of your questions until the end of the presentation. Now hand it over to David.
Thanks so much for the introduction, and thanks everybody for both being here in person as well as online joining for the presentation today. We're going to be providing an update regarding Xtraction Services. We recently went public about 2 weeks ago. I'm going to start by saying now is a very akin time in the market to when actually my prior business, when we got into the real estate space in the United States, which was 2009 after the housing market crashed. It was a distressed market, and there were a lot of interesting opportunities. Capital was scarce, but there were a lot of interesting assets that frankly could grow a very meaningful business, and that's ultimately how we grew by picking off distressed acquisitions between 2009 and 2012, and then growing that into $300 million in revenue as we put those into production. The time is akin now for a similar space in that the equity capital markets in our industry are upside down, and we are very much open for business. We are an alternative source of financing for a lot of companies that do not right now have access to the capital markets where they were raising capital, and so we think that's very advantageous for what we do. On a high-level basis, we principally do three things. We provide equipment leasing solutions, so we're a financier to help companies either acquire new equipment or unlock capital out of equipment they already own, vis-a-vis a sale-leaseback. We provide consulting services to help them select equipment, help them set up their processing labs, and we also work with 40 or 50 different equipment manufacturers with whom provide us leads to finance their customers and who we buy equipment from. So why do we like this business, and why do we think now is a very interesting time for our business? One, we operate with significant operating leverage. Unlike a lot of our customers, we don't need a tremendous amount of staff. We don't need people across the country. We can operate in 1 or 2 offices with a select number of people to underwrite and verify transactions for customers for leasing. What that does is it generates high EBITDA margins. And through our leasing services, which we'll talk about in a bit, and a low G&A, that's ultimately how we get to cash flow stabilization and profitability on a near-term basis. Recurring revenue stream. When we put out a piece of equipment with financing, obviously somebody's locking into a long-term transaction that's providing recurring revenue for us, and all we're doing is servicing the account at that point. This is of tremendous importance. We are not subject to 280E taxation like many of our customers. We run a traditional business with a traditional tax structure, and actually, thanks to the Trump tax regime that was put in place in the United States, we get the benefit of near-term depreciation, and we own all of the equipment that we lease out. We have an experienced team. As I mentioned, my prior business, we grew to about $300 million in revenue. We were the 3rd fastest growing private company in Los Angeles in 2015, top 100 again in 2016, and saw another amazing opportunity to do what we did then in cannabis, and specifically in equipment leasing in 2017. And we think that this is a very big opportunity. Equipment leasing exists in every industry across the world, and we're bringing something that does not exist in this industry, but in a traditional format. Obviously, we are a pick and shovels business. We are a finance company who provides consulting services and equipment services. I think everyone's aware that the cannabis market is expected to grow dramatically. The hemp market is expected to grow dramatically as well, and we are a provider of services and financing to the industry of that growth. The important thing to understand is, in this market in particular, when we're seeing equity values dropping across the board, Xtraction Services presents the opportunity to get the upside in the cannabis trade with substantial downside risk mitigation. We own all of the equipment. There's recurring revenue, traditional tax structure. Those things are important, particularly as the market goes through a bit of a shakeout right now. As you can see here, one of our core markets in terms of the actual product that we service is for the oils market, processing, and those that ultimately take that oil and produce it into various types of products. One of our largest segments of equipment leasing is Xtraction pre- and post-processing equipment, And we also service additional segments of the market, which we'll talk about through the presentation. So what are the challenges right now in the market, and ultimately, how are we solving those challenges? The market, particularly right now, is capital constrained. It already was capital constrained before the equity capital markets started into this recent 6-month decline, and we are an alternative source of funding for all of these companies. We think that that's a very important differentiator between us and who our customer base is. We operate much more like a finance company, not a cannabis company. And that's an important distinction, particularly in a market like this. Two, the equipment that we ultimately provide leasing options for is expensive. It's costly. To build out a processing lab or an outdoor cultivation or a finishing alternative for packaging, filling, all these types of things. The equipment is very expensive, particularly in the United States, where you have to set up infrastructure in multiple states or multiple locations. What does that mean? They need a lot more financing, the customers that we're working with, but they shouldn't have to raise equity, and right now, unfortunately, a lot of them can't, to go and purchase that equipment and or refinance the equipment that they've already purchased. That is the solution that we're providing to that issue. As mentioned, it's also evolving technology. Companies want to become more efficient. They want to stay ahead of that curve in terms of producing at the lowest cost. That means that they're going to need more options to upgrade and ultimately, trade out what they already have in exchange for newer equipment, thus the financing that we provide. One of the things that we've done recently is we've gone to all of our equipment vendor partners and we've started launching an equipment sale leaseback promotion in concert with them. So what does that mean? We go to customers who have already purchased equipment from them in the past and we say, look, we now work with Xtraction Services. They can help unlock capital from equipment that you've previously purchased, and if you do that, and obviously now the customer will have more cash in hand, we will now give you a promotion to come and buy new equipment from us. So it's a very good working relationship between the equipment manufacturers, us, and the customers themselves, which is very important. And obviously, as mentioned, they need to adopt these new technologies to remain competitive. So how do we ultimately run the business? As mentioned, we partner with leading equipment manufacturers to provide end-use solutions on the leasing side for the customers, in addition to the consulting services and equipment specification surrounding all of our equipment vendors. It's a high-margin business model. That's why we like the business. It's a highly scalable platform. We don't need to set up infrastructure in every state like all of our customers. We can operate out of one office, underwrite transactions that are nationwide. It's very simple from that respect. Two, it's a proven business model from a multiple variety of ways of looking at it. One, equipment leasing exists in every industry for a reason. It's necessary. You shouldn't have to go and dilute the company to go and buy equipment. That's an inefficient business model. But beyond that, we already have customers, we're already in the market, we already have recurring revenue, and actually we'll be putting out news tomorrow, but our largest customer who has not come online, things will be improving in terms of them being a revenue contributor to our business as well. And so all of our existing leases will be active and essentially producing for us. And the most important thing, which is not discussed, is the customers that we have on the cannabis side, because of 280E, cannot write off interest expense. So what that means is if they go and borrow money, if they take out a loan, they're actually paying twice for that loan. They can't deduct the interest expense against their earnings. Well, with a lease payment, they can deduct it in full. So the net effective cost to our customers versus them going and taking out a loan is dramatically different, which is a huge differentiator. And that's something that we're working very hard to sell to the customer base. How do we produce revenue? Principally, as I mentioned, in a couple different formats. One is we have two different ways to unlock financing from us or leasing options from us. One is you're purchasing a piece of equipment new and we provide a lease. Pretty traditional, customer puts down a down payment. We ultimately collect that down payment, enter into a contract, go and purchase the equipment from the vendor that we either have a relationship with or will be putting together a relationship with. And then also the sale leaseback program, which we just launched about a month and a half or 2 months ago, which has brought in an inundated amount of leads to us through that process because it's something that nobody else is really offering and that we now have. We also provide, as mentioned, on-site support and equipment procurement services through our consulting division. It's very important. There's a lot of customers out there that need expertise in running a processing lab. They don't know what equipment to buy. They don't know how to work backwards relative to what they're trying to produce based on what their capital availability is and what their infrastructure looks like. We're there to help them identify what equipment they need, and in doing so helps us obviously become very involved in their business, which is very important to build that customer relationship with them beyond just providing a financing option. Good example of a case study. This is an existing customer right now. This was actually a hybrid deal that we did. We provided consulting services and we provided a lease. As you can see here, we paid about $1.5 million for equipment. Lease term was 30 months. Total amount leased was that same $1.5 million. We had a monthly payment plus royalty in exchange for consulting services of $136,000 a month. The end of term buyout, which was ultimately for the customer to acquire the equipment, was 15% of the original cost, which is how they get to $225,000, thus giving us a $3 million total revenue opportunity over the period of the lease, and our cost was covered in 20 months, and you can see the type of gross IRR that was driven through that. In an industry of folks talking about top-line sales and not talking about NOI net of tax, we're a business that's focused on near-term payback on equipment, owning the assets all the way through, getting the benefit of the depreciation until we sell it back to the customer, and driving a high return on our invested capital. This is a differentiated business model from most of the cannabis companies that you'll see out there, because we're not a cannabis company. We understand how to help cannabis companies. We are a finance company that's servicing the marketplace. This is how we generate our returns. Here's the existing customer base and some of the pipeline. We have active leases, 2 of them in South Carolina. Those are both hemp customers. We have another 2 active leases in Kentucky, also hemp processors. We've completed equipment sales in Oregon, LA, and then you can see some of the pipeline that's below. Our biggest issue right now is we actually do not have enough capital to fund all of the demand that we have. The benefit of that is we can cherry pick the customers who we work with, focus on credit quality, focus on the advance amounts, focus on not exceeding ourselves in terms of the risk exposure that we want to take, and working with better customers as we move forward. We have a big sales funnel. Right now, especially given where the equity capital markets are, we have a tremendous amount of inbound demand. We're receiving inbounds from any number of places. Direct, we're receiving it from the equipment manufacturers themselves. We've been receiving them from, frankly, a bunch of investors, brokers, and bankers both in the US and Canada who have accounts that they work with who need financing. We've told everybody, send them to us. We'd like to speak to everyone's customers, and I think that's shown here in the sense that we want to look at as many different deals as we can to ultimately make the best selections in terms of how we're actually providing leasing to the marketplace. This is a sample of some of our preferred vendors. As you can see here, we actually do a distribution model on sales for Cushco. We sell through their consumables, their packaging to our customers. Capna Systems, Downtown Hydro and Elevated Equipment Supply, some of the largest equipment distributors on the West Coast. We have a preferred financing arrangement with them. If you go on their website, it actually is a white label financing solution that we've put on their website, where if a lead comes in at the point of sale for their product, it comes back to our website to immediately go into underwriting. And you can see many of the other customers we work with here. This is certainly not everyone we work with, but as you can see, this is an expanding array of manufacturers on a daily basis as more customers identify more different types of product that they want to work with, and more groups reach out to us because customers are coming to these businesses, picking out equipment, and then their equity raises are delayed, other financings that they were working on are delayed, and we can provide that point of sale financing to help them make a sale. So you can see here from our cap table, we as founders agreed to a 3-year hard lockup. So we're here to build a long-term business. A lot of the shares that we have in the business right now are locked up, so there's not a lot of free trading shares, which is seen by the amount of trading volume that we've had through the first week or 2 of trading. But we think we have a good cap structure to propel us and ultimately raise the stock. Right now we're trading at 20 cents, give or take, which is roughly in line with cash plus the equipment that we have. So assuming no upside in our stock relative to just the assets that we have on the books, which we think is tremendously undervalued. We're not a company that burns cash. We have a tremendous amount of demand in front of us, and the leases that we are negotiating right now are exceptionally high yielding. That combination should propel us away from the traditional market metrics related to cannabis companies and much more akin to a high growth finance company, which is what we are. As you can see here from our board of directors, you have myself and our Chief Marketing Officer, Anthony Radbod, Gary Herman, who's worked with small and micro-cap companies for the better part of 30 years in New York, and Stephen Christofferson, who's the Corporate Development Director for Kushco Holdings, which is one of the largest ancillary businesses in the States right now. The leadership team pretty much speaks to exactly the type of business that we are. There's not a whole lot of folks in the company beyond what you see here. We have myself, CEO of the company as mentioned, my prior real estate business. Before that, I worked in structured credit and for the largest alternative investment advisor in the United States, Hamilton Lane Advisors. Anthony Radbod, who I mentioned, who's our Chief Marketing Officer, who himself has been involved in quite a few successful startups as both an investor and an operator. Joe Fazzini, who used to be with Dundee on the equity research side and is our CFO. Alex Carroll, who runs all of the technology for our business. That's on-site operations, equipment specification. Used to run the lab for Knox Medical, which is now part of Consortium. And Matt Swazi, who is our lead underwriting director and ultimately tears through credit on all the different companies that we look at. As you can see here, we've been featured in a bunch of press. Now that we're public, obviously going out to the market to be much more out there in terms of the story, the differentiation, who we are, and making sure that everyone knows that we exist and why we have such a high-octane business model. I'm based in LA, which is where most of the company is, and our tech team is down in Florida, so we have East and West Coast coverage across the United States, which is where the focus is for our opportunity right now. I should point this out, the federal illegality and state legality makes our product particularly attractive, not only because it's on a net effective basis to all of our customers who are subject to 280E, but because of that federal illegality, equipment leasing companies and lenders on the institutional side cannot participate. And so we have a blue ocean in front of us with very, very limited competition. We are not competing for market sizing in all of the different states across the US like our customers. We are broad-based and do not have a lot of competition to contend with. And that's Xtraction Services. Can I help answer any questions either online or in person?
Can you just go through some of the numbers and how much cash you have currently, what the revenue expectations are next year?
Sure. So right now we have about $3.5 million in cash. We have no, I guess, near-term, debt issue to deal with, so we have a clean balance sheet from that perspective. The objective right now is twofold. One is we will sign leases using the cash that's on the balance sheet and from the recurring revenue that we have from our existing customers. And then we are also term sheet in hand, but working through a credit facility to really help lever the model. Obviously, that's where this starts to take off. It's very akin to when we started the real estate business back in 2009. When we went for construction financing in 2012, the banks were still, essentially shell-shocked from the housing market crash. And what we found was City National Bank at the time said, look, we're not going to let you build 132 homes, but we'll let you build 9. Prove your model. Well, we've proven it with the 4 customers we have. That's why we have term sheets in hand from lenders. And now it's ramping up that activity with 1 in tow so that we're not using our operating capital to fund leases. Between the customer down payment and a credit facility, that's how we really ramp up the business. In terms of projections, it's really dependent on which deals we end up doing, the size of those deals, so I don't necessarily want to overly project revenue from that perspective. It's very dependent on the individual deals, but the 4 leases that we have in hand are about $2.5 to $3 million of ARR just from what we have currently, which is more than enough to support our existing burn.
How big a credit facility are you looking for in the term sheets you're involved in right now?
Sure. So I'll say it the way that they deemed it at City National Bank when we started. We're looking for our starter facility. So the answer is $5 to $10 million US. starting with a first tranche against the existing leases that we have in place, so there's not a lot of mystery to that, and then a standby letter. We're looking at rates in the range of low teens to mid-teens. I think what's interesting is, particularly if the Safe Banking Act comes through the Senate in the United States, I don't think there are a lot of U.S. institutions or a lot of U.S. Credit providers, as an example, that are going to immediately go and run and provide leverage to small and medium-sized cannabis companies that, frankly, they're not really in the business to underwrite in the first place. I think, if anything, once that availability of credit comes into the marketplace, I think we become a natural spot for them to lend against our portfolio for all the reasons that I think we have a good risk-mitigated model. So I think it will drive down our borrowing cost of capital, which then we can pass on to the customers. There are questions in person?
In terms of your credit protection, what do you do? How do you structure your leases to protect yourselves from a lease which goes south, say?
It's an excellent question. So there's two dynamics to think about in the market right now. One is, what is the actual equipment worth? What other types of credit enhancement can we seek when signing a lease? And ultimately, what's our advance rate against whatever the collateral is? Right now, we're looking at deals where our advance rates are south of 50% of the depreciated value of equipment. And the benefit of what we have going on right now in the US, and actually here in Canada as well, is the equipment is in high demand and not readily available at the manufacturer level. As an example, we just elected in one of our facilities in Kentucky to upgrade a piece of equipment. We bought it last fall for $190,000. We just sold it for $180,000 a year in. So right now, if a customer is looking for a piece of equipment, they can't easily access it. That's not always going to be the dynamic. So how do we account for that? Additional forms of credit enhancement. So on a new lease, a company may have existing equipment on their books. We will take a lien on some of that equipment. We've looked at real estate as a form of enhanced collateral. We've also looked at personal guarantees, and we've also looked at marketable securities. So there's any number of different ways that we can enhance the credit quality of the leases that we're doing. What's important to understand is the customers do not have a lot of alternatives right now. So we're not competing with other companies to say, hey, let's go be really aggressive on advance rates. Let's go be really aggressive in terms of term. Let's go be really aggressive in terms of rate. We don't have that level of competition. So we're open for business. We have more demand than we can actually supply capital to at this moment in time. And so we want to be very careful about how we underwrite.
If the U.S. makes it clear they'll federally legalize, how does it impact your competitive advantage?
Sure. So it relates in some respects to what I just said about, the SAFE Act, right? The Senate Banking Act. And what's important to understand is United States banks, and I don't know about Canada, but at least in the United States, are not really set up to lend money to small and medium-sized businesses. That's why this entire wave of alternative lenders has come into the market, and what the banks have essentially done is provided credit facilities to those guys. And so what I think ultimately ends up happening is I think they look at our model relative to the cannabis business model, and I think we become a much more natural place for a credit facility to be provided. Why? Traditional business model, protection in terms of collateral, low loan to values, and the things that actually matter to a bank. Right now, I think until a lot of the customers truly get competitive advantage one versus the other and become not only cash flow positive, but EBITDA positive, and then ultimately NOI positive, I think we become a much more natural place to drive down our borrowing cost, not our customers.
Another question, just on the kind of macro picture. Do you expect to see some consolidation in the industry right now in the cannabis sector, and does that enhance your opportunities?
So I do think there's going to be consolidation. I think it's coming. And I think, frankly, with everyone in town right now, I think there's going to be an awful lot of discussions about it. As I joke, I say everyone is talking to the guy below them, the guy next to them, and the guy above them, because everyone's talking to everybody. Inevitably, none of the infrastructure that's in place in the United States right now comes anywhere close to serving the demand that's coming online, either inline or coming online. And ultimately, that's why the black market, the gray market, that's why they can actually operate. Once that area is focused on, I think that'll help a lot of our customers as well, because right now that's their biggest form of competition, not necessarily the next MSO or the company next to them, but it's coming. Ultimately, how does it impact our business model? In the near term, I don't think it has a big impact because, like I said, they're all underproducing relative to what the demand levels are. So they're all looking to grow right now. So either they're going to grow by acquiring new forms of equipment through us, or they're going to go and acquire a business that's next to them, try and unlock some capital out of the equipment that's in the company that they actually acquired, and then use that cash to expand, whether on sales, marketing, or frankly, even buying more equipment. But it's a very good question.
What is your burn and what's your source of funds other than treasury offering?
Sure. So right now, the burn is in the range of about $100,000 a month. As mentioned, our largest customer, which we're putting some news out about tomorrow, is soon to be a large contributor to revenue. So that will certainly help on that level. And so you're talking about a company that does not have a tremendous burn. We're not looking to increase infrastructure in any respect. And frankly, we can operate our business even up to multiple leases per month closed with the infrastructure that we have in place now. So the other source of capital that we're working on, as mentioned, outside of cash on hand and the recurring revenue that's coming from the leases that we have in place, is we do own some equipment on our balance sheet. We will either put that as revenue into revenue producing mode vis-a-vis a sale or additional leases, plus the credit facility that we're working on now. Those conversations have sped up dramatically now that we got the financing done and now that we're public.
How large is your credit facility?
As mentioned, we're looking for about $5 to $10 million to start, and we'll ultimately turn that into something substantially larger once we show a little bit of performance. It's very akin, as I mentioned, to what we did in real estate. We started by borrowing about $6 million to build our first phase of production homes. We then ultimately borrowed and paid back every cent of $250 million of construction financing. But you have to walk, jog, run. The good news from the lending perspective is they can see quite clearly that our pipeline outpaces what we can produce right now. And I think from an underwriting perspective, they understand the collateral support that we have on these deals.
With the size of your skeleton staff crew, how quickly can you ramp up the underwriting for all the leases if you wanted to really ramp it up over once you get the credit facility?
Sure. It doesn't take a whole lot of additional folks, candidly. Perhaps we would add 1 or 2 underwriters to the team, but right now, even with the amount of demand that we have, again, we're cherry picking the deals that we want to do. Not everybody of those 2,000 leads or the 85 that are even reasonably qualified necessarily are going to get to the finish line. We want to focus on credit quality more than we want to focus on size. If the portfolio performs, we have a lot of flexibility, right? We want to be cash flow positive and ultimately profitable, because when you hit markets like this, that gives you maximum flexibility. So to answer the question, maybe add 1 or 2 in 6 or 12 months once we really, really ramp up, when you get to 3, 4 leases a month. But right now, we're absolutely fine to operate in the dynamic that we're in. That's not the whole team, but it's the senior folks that matter.
Can you give an example of the kind of deal you can negotiate now in this environment versus a year ago?
Sure.
What's changed?
So, well, capital's not nearly as readily available. And the deal sizes that we're looking for, back then I think we were very focused on only new leases. And what we found was when we were focused on new leases, we were getting customers in many respects that hadn't necessarily set up yet. Well, what we learned through that process is folks who have not been through a full season, a full sales cycle, found their ultimate sales roads into the industry, it's not that easy a business, right? Once you produce oil, you have to figure out how to sell oil. You have to figure out how to ultimately produce end products. It's not as simple as most guys who set up operations think it's going to be. And so the reason that we launched the sale-leaseback product was to get in with companies who have already figured those things out to de-risk our portfolio. We want to make sure we're working with existing operators who have revenue, have vendors, have already gone through some of the kind of pains of getting scale in this space. And so how do the deals differ today? A good example of one that we're looking at right now. We're looking at a deal that has roughly $2 million in equipment costs, depreciated book values around $1.9 million, and we're looking at a $550,000 lease against that depreciated book value. It's all brand name equipment. We could easily redeploy it with no issue, and we'd be underwriting into the low 40% on a gross yield basis. And so because we have such a low advance rate, because the residual value of the equipment is spectacular, that's the type of deals that we're looking to do, and it's a real counterparty. But we have many of those available to us, and I'd say, for where the business is right now, The only group that we do not move the needle for are the largest of the MSOs, because they'll go out and get large-scale credit facilities that'll basically take a senior lien on all of their assets. But for the tier beneath them and 2 tiers beneath them, that group is underserved. And so we're really talking to the group that's doing $500,000 a month in revenue up to about $6,000 or $7,000 a month in revenue. But again, they have very limited options right now, and that's really the focus of what we're trying to provide to them, which is we're not trying to provide a cannabis product. We're trying to provide a financial product. And that's a very big difference between our business and everyone else. Yes?
When would you expect being profitable?
2020.
What do revenues look like for this year and going into next year?
So this year we should end the year in the range of about $2.5 to $3 million in revenue. And as mentioned, that off of the existing book gets us to an ARR next year that looks more like 3, and that's before signing any new leases. And obviously we intend to sign a lot more leases, and that's without putting some of the additional equipment that we have on our balance sheet into either revenue producing mode or service revenue producing mode, either on a lease or a sale. So that's going to ramp up meaningfully next year. Because ours is a transactional business, not necessarily organic growth of, hey, we're going to sell 2 more products this month or 3 more products this month. It's very dependent on the actual deals themselves. So they're obviously all structured a little bit differently. And of course, if we get royalties on top of the deals, that amps up revenue meaningfully.
So your market cap is roughly at this level is around $5 million, is that right?
I think we're trading, around 7, 8, 9 million, something like that.
And what with the finance companies such as yours, what expectations you have for multiple expansion, or if you hit those numbers next year,
Yeah.
$3 million from existing leases, adding a few new leases next year, what kind of finance or lease companies would you see would be comparable as far as what you'd expect to see?
Yeah, so it's hard to look at traditional finance companies because they operate in traditional industries, typically with a lot of competition. They're fighting for leads, they're paying an arm and a leg for those leads, and then they're ultimately competing and or reducing credit quality to get higher yield, whereas we're not competing. So I think ultimately you're going to see a pretty tremendous multiple placed on us. Right now, our stock is trading incredibly inexpensively, in my opinion. And I think you're going to see, once the market understands, A, we sign a couple of leases and they understand who our counterparties are, and B, once they see the types of returns that we can generate from these leases and the amount of credit risk that we're actually taking relative to the leases that we're doing, I think eventually there's going to be a point where the market understands the difference between a company that's in the cannabis space, inefficiently taxed, and what that looks like, and an extremely high growth finance company that ultimately is going to be serving a larger share of the market and certainly a larger share of the high end of the market, and particularly once we have access to more credit availability ourselves. Any other questions?
You have an example here of a customer case study. Could you walk us through that, please?
Sure. Bring that back up. So this being an example of kind of the best of what all 3 of our divisions actually do, which is we procure equipment, we lease equipment, and we provide ongoing consulting services for that equipment. And in this case, we structured a lease on the equipment, and for those extra consulting services, we effectively get paid a royalty, right? We've aligned our consulting services alongside the production capability of what that equipment's going to produce. So here,
So the lease payment is $50,000 a month.
so that's correct. Yeah, technically, it's actually a $50,000 minimum payment. So the way that the contract works, we get the greater of a guaranteed minimum every month, come rain, shine, what have you, and or the production level value of what actually happens in the facility. So we have that minimum in there because we need to make sure that we cover our lease payments. However, in exchange for providing all these additional services, we've recruited their entire team. We've provided them formulation guidance. We've provided them on-site support. We provide them backup for the equipment if necessary, right, in terms of repair, parts, this and that. And in exchange for that, we align ourselves into the volume of the company. It's important to understand one thing, though. We do not participate in top line. So if they sell their product for more, that goes 100% to the customer. We are a fixed cost. And the reason for that is we do not even want to be close to being deemed anything related to profit sharing in a cannabis company. And so we remain 100% a leasing company and a servicing company outside of that type of business model. And so here, as you can see, we've basically projected based on volume, but the $50K payment in the beginning is related to the minimum monthly payment. And so here, as mentioned, our cost was $1.5 million, a lease term of 30 months. That was ultimately the lease amount. Although moving forward, you will see a much larger share of down payment. This was one of the first deals that we did, where we essentially provided everything up front. Moving forward, we have a minimum requirement in the range of 30% down payment from the customer to even activate a new lease.
What happens if your leasing client goes belly up? Is the cost of taking equipment out included in your business model?
So yes, the short answer is right now, as mentioned, the equipment is much more valuable in hand. And so, we technically don't want to think about leases as if they go bad, that actually ends up working out better for us. But right now, the equipment is in such high demand that actually net of down payment, net of whatever payments have been made, that equipment is more than likely more valuable being resold in the marketplace, certainly in the coming year or two. So for right now, the answer is yes, it's covered in the business model, but we would be able to redeploy that equipment pretty easily. Moving forward, obviously that's why we focus on those other forms of credit enhancement. So if the business goes belly up, but we have a personal guarantee, there's a reason that we took that personal guarantee. It's because we couldn't get comfortable with the credit risk purely at the corporate level, or if we're taking other forms of credit enhancement, real estate, other equipment that they've owned in the past, that's why we do those things. So if we can't get there on purely credit related to the company and the individual piece of equipment that we're leasing, that's why we look to those other forms of additional collateral.
Thank you very much, David. We appreciate your time.
Thanks everyone for joining online, and thanks everyone for being here in person, and thank you guys for all the good questions.